Kathy, what do we make of this bond market? We started the year, just below 4% on the 10-year yield, and there might be people out there that were thinking, darn it, I meant to lock in some bond yields here and I've missed my chance. And now we've got a high-ish or higher than expected reading on inflation, and bond yields have backed up a bit. Where are we headed now? Are they going to stay here? I think the 10-year I saw is at a 4.30 or thereabouts. What do you expect for the rest of the year? How long will the getting be good on these yields?
Yeah, it has been, Jack, quite a roller coaster this year. We ran all the way up to 502 on the 10-year Treasury and fell back to 380 something, and now we're about 4.25. Our view is that the overall trend in yields will continue to be lower in the second half of the year. We do expect the Fed to lower rates because inflation's coming down, but that's going to be a bumpy ride too. It's not going to be a smooth path.
You need a lot of money to diversify a bond portfolio of individual issues properly. I've heard people say, well, I want to own individual bonds because I have a maturity date and I know what I'm getting, and I know when it comes due, I'll get this money back and so on. I don't want to have a fund because it's not defined when I get the money back in the fund. Is that a legitimate concern, or is that a misplaced concern?
Well, I think it, again, comes back to the individual investor, right? So if you're the type of person who, say, would look at the value of the net asset value of your fund going down and say, oh my gosh, I'm losing money, and sell when it's down, even if you have a 5-year time horizon, then you probably would be better off in individual bonds because you'd be more likely to hold them because you know what you're getting, when you're getting, and your principal back at par. But a fund can perform just as well as individual bonds, sometimes better. It all depends on sticking to your discipline and your holding period. So we've done the math to look at performance of, say, a diversified fund versus individual bonds, kind of similar kind of assets in it. And a bond fund is just a collection of bonds, right? So we've looked at the performance of the two. And if you start out and say, I'm going to hold this for 5 years, and they're very similar portfolios, chances are you're going to end up with kind of the same outcome at the end.
What do you think when you look at the level of the federal debt in the U.S.? Do you think, I used to panic about it 20 years ago. Now I feel like I'm not as panicked, although the numbers say I should be much more panicked. Is there a path to a happy outcome or a benign outcome here? You must think about this as a bond strategist about, what becomes of that over the next 20 years? What do you think happens? What's the path there?
Well, the path should be that our debt grows more slowly than our economy. And then that debt to GDP would level off and start to come down. So that's it's sustainable in the sense that I think the average yield right now we're looking at on the Treasury market still 2.7%. So we have a huge economy, generates trillions and trillions of dollars. We have trillions of dollars in assets. There's no question that we can't pay our bills, right? We can, but the trajectory is not very good because that debt is growing faster than the economy. And at some point, either you run into what they call crowding out, where we can't do the things we want to do because we're spending more money on the debt. And if we were to issue even more, would investors say, hey, you've run up so much debt, we need a higher yield than that? And it sort of compounds itself. We haven't reached that point. There's nobody who can tell you with any precision what that point, that magic number is, or if we'll ever get there in our lifetimes. But when we talk about sustainability, we worry about just the fast growth rate in debt relative to the economy. Now, having said that, we've had really good news on productivity. So if you're a country that's issuing debt, or any entity really, and that debt produces faster real growth, then there's something to be said for that being used well. So if that allows us to grow at a faster rate because we have higher productivity, not necessarily bad investment.